Hey everyone, and welcome to this explainer. Today, we're jumping right into some incredibly important stuff. We are unpacking Chapter 1 of the ACCA Advanced Audit and Assurance Material, the regulatory environment. Now look, I know what you might be thinking. Regulations, rules, but stick with me here, because we aren't just looking at dry, boring rulebooks today. We are examining the absolute bedrock of the financial markets. Think of this less like a textbook and more like a high-stakes corporate thriller. At the very heart of global finance is this incredibly fragile web of trust. And today, we're exploring the ultimate playbook that keeps that entire web from snapping. We're talking about the intense public oversight of audit practices and the incredibly heavy, absolutely critical burden that's placed on the Audit Committee to prevent total financial disaster.
Okay, let's dive into this. Seriously, what actually stops a corporate collapse? When a massive, multi-billion-dollar multinational company suddenly implodes out of nowhere, the immediate public outcry is literally always, where were the auditors? But, that leads us to a much deeper systemic question. Who audits the auditors? Like, what actually prevents complete chaos in our public markets? Well, the answer is a rigid, multi-layered system of regulation. Because without a strict, ironclad framework enforcing transparency, capital markets wouldn't just slow down. They would simply freeze. No trust, no investment. It's that simple.
So here is our agenda for this explainer. We're going to be taking a 3 lines of defense approach, moving from the macro level right down to the micro decisions. First, why audit regulation matters. Second, the UK Corporate Governance Code. Third, the Audit Committee's mandate. Fourth, appointing and removing auditors. And finally, monitoring non-audit services. Let's hit Section 1, why audit regulation matters, and specifically, the absolute need for public oversight.
Here are the core pillars of our very first line of defense. First up, implementing foundational laws. Look, you simply cannot rely on the honor system when it comes to reporting corporate profits to shareholders. There's just too much on the line. Second, mandating public oversight. The auditing profession absolutely cannot regulate itself in the shadows. External, public-facing bodies have to step in to ensure auditors are actually doing their jobs correctly. And third, these two things combine to safeguard audit practices. Because think about it, if investors don't trust the audit, they don't trust the financial statements. And if that happens, the flow of capital stops dead in its tracks.
Moving right along to Section 2, the UK Corporate Governance Code and its impact on audit firms.
Now, what's really interesting about this slide is how deeply the UK Corporate Governance Code impacts the day-to-day reality of audit firms. We're not just talking about some theoretical high-level document here. It dictates strict operational and ethical standards. It fundamentally shapes how audit firms interact with their clients by demanding rigorous, professional skepticism. It explicitly tells auditors, hey, you cannot just accept management's word for it. You must challenge them. This literally forces audit firms to structure their entire internal operations to prioritize objective truth over just, keeping the client happy.
Which brings us to Section 3, the Audit Committee's mandate. This is what we call the crucial buffer.
And this brilliantly illustrates the 3-pronged mandate, the really heavy lifting, done by the Audit Committee. For appointments, they are the ones sourcing the external auditors. For removal, they actually hold the trigger to fire compromised auditors. And for monitoring, they oversee the ongoing operations. The Audit Committee is that crucial buffer. If a company's executive management handled all of this, auditors would be absolutely terrified to ever deliver bad news. By ensuring the Audit Committee is made up of independent, non-executive directors, it acts like a shield, totally protecting the auditors from management's influence.
Let's zoom in a bit more on Section 4, appointing and removing auditors. This is all about enforcing independence. These sequential steps we're looking at, they are absolute power moves for governance. Step 1, managing the appointment. The Audit Committee doesn't just quietly sign off on a CEO's decision. They actively drive the entire sourcing process. They evaluate the firm's competence and independence way before presenting a formal recommendation to the shareholders. And Step 2, executing the removal. If an auditor loses their independence or fails to deliver a quality audit, the committee manages their exit. Holding the keys to this entire life cycle completely neutralizes the ultimate threat for management, which is usually some version of, give us a clean audit report or we'll just go find someone else who will.
All right, on to our final stop, Section 5, monitoring non-audit services, the ultimate conflict of interest.
There is a massive inherent tension between external audit services and non-audit services.
Non-audit services are highly lucrative things for these firms. We're talking tax consulting, IT system implementation, or business valuations. Now imagine an audit firm builds a multi-million-dollar IT system for a company, right? And then later on, as the auditor, that exact same firm has to audit whether that specific system is accurately reporting financial data. It's a classic self-review threat. They're basically grading their own homework. So the crucial point is, this is exactly why any non-audit service must be fiercely monitored and explicitly approved by the Audit Committee to protect the overall integrity of the audit.
So we've covered a lot of ground today. We've looked at the macro laws, the corporate governance code, and those really high-stakes micro-level decisions made by the Audit Committee. But I want to end this explainer by leaving you with this one provocative question. Regulation can force compliance, but can it actually guarantee integrity? We can build all the lines of defense in the world, mandate strict oversight, and give committees ultimate hiring and firing power. But ultimately, when push comes to shove, these systems completely rely on the professional courage of the individuals enforcing them. Governance provides the rulebook for sure, but true oversight requires human integrity. Think about how these frameworks apply the next time you're reviewing an audit scenario. Thank you so much for joining me for this explainer, and keep questioning the systems that govern our markets.